Well, half-year reporting season is upon us once again, and this is a time when most companies on the Aussie share market will tell investors exactly how they're fared over the 6 months to December 2025. It can actually offer up buying and selling opportunities for investors that are paying careful attention, because you often get bigger than usual share price movements on the day that companies are releasing the results. And that's why the market backdrop is super important to be aware of. We're basically heading into February with our share market being within striking distance of a record high. Things have varied a lot though from one part of the market to the next, and if we had to boil it down simply, basically the mining sector has been shooting the lights out, up almost 40% in 6 months. The top 10 performing stocks on our market over that period have all been resource stocks. The rest of the market has been a bit more underwhelming.
And I think it's important to point out why exactly we have seen the materials sector performing so well. And of course, we do have that commodity tailwind. So if we have a look at commodity prices over the past year, gold up 88%, silver up 268%. We're seeing copper up around 40%, lithium prices up 122%, and iron ore lagging behind the rest, up by around 5% over the past 12 months. So we can really see those precious metals have been driving things forward, and I think that's really been reflected in what we've seen from quarterly updates from some of our gold miners in recent times, and that could potentially be a tailwind this February reporting season as well.
Absolutely. There's been a flight to safety. A lot of money been flowing to gold and also silver as well. I mean, Trump's tariffs have played a part here. The weaker US dollar, central bank buying, all of these things have contributed. So, of course, gold miners have really taken advantage of higher prices. And we know that when gold prices or other commodities lifting a lot, that has generally an even stronger impact, a positive one, on earnings and the bottom line and margins of these companies. And the risk also going into 2026 or throughout the year is that there could even be higher gold prices too, because of, the continued geopolitical uncertainties, which could just add to that trade.
Absolutely. I mean, gold actually hit $5,100 per ounce just recently. Silver topped $115 per ounce recently, and there are forecasts that trend will continue. CBA economists expect gold to reach $6,000 an ounce by Q4 in 2026, and silver reaching $140 per ounce by the fourth quarter of this year. So those expectations that these prices will continue to rally could potentially be again a tailwind for those miners going into this reporting season. Another thing that we should mention is that the gold miners have actually been outperforming the underlying gold price itself, and that's because those margins are absolutely huge in terms of the price that they're selling their gold at versus the cost that they actually have to pay. So if we look at a company like Evolution Mining, its margin is absolutely huge. It's almost 5,000 Aussie dollars per ounce. Some of the other miners a little bit less, around the $2,000 per ounce mark in terms of margins for the amount of gold that they sell.
Iron ore hasn't done anywhere near as well. It is Australia's biggest export, so we've got to mention it. But even though it has lagged behind, gold and silver and copper, which has been hitting record highs as well, it's been more resilient than many had actually feared not too long ago. So that could be helpful for earnings. I mean, CBA was expecting iron ore prices to be around $94-95 per ton in the December quarter. It's been hanging around 105 to 110, so that's quite helpful. BHP also has generally done quite well on the market recently.
Yeah, it certainly has. In fact, it's overtaken CBA as the largest stock on the Aussie market. And today, of course, we're recording towards the end of January. It's actually hit its highest level ever on record. So big expectations, I think, going into this reporting season for BHP. And of course, we can't talk about commodity prices without looking at what's going on with China. Of course, last year in 2025, they did manage to reach their economic goals in terms of growth, GDP of around 5%. And this year, they haven't announced it just yet. That generally comes out around early March. Yep. But some economists are expecting around a 4.5% growth in this year. And of course, China is very important because they're the biggest buyer of commodities globally by far.
Yeah, and many of these iron ore producers are trying to diversify, how they make money, because iron ore hasn't done particularly well. So BHP recently upgraded its expectations for copper for the year. Had some issues with cost as well, so that's going to be something to watch, of course, not only for the likes of BHP, but pretty much all of the miners, because they can, enjoy the benefits that come from higher and record commodity prices, but what can they do about controlling the controllables? And that's why costs are going to continue to be critical. Rio Tinto has lagged on the ASX in January, while BHP's done better. And that's partly because of those merger talks with mining giant Glencore as well, to potentially create the world's largest miner. But that would mean a lot of money being spent, and mergers can be very messy and complex and expensive as well. And Fortescue has recently disappointed with cost, which have been, towards the top end of what it expected.
And of course, while we're talking about commodity prices, we should mention energy stocks and oil as well. I had a look at the oil price over the past 1 year, and it's actually fallen by around 14%. Of course, you mentioned those geopolitical uncertainties. There are expectations of a deep surplus in oil, and that could potentially offset those geopolitical tensions. In fact, the International Energy Agency expects record surplus in 2026. So this is something that could potentially weigh on energy stocks leading into this reporting season.
Absolutely. And look, Woodside just at the end of January released a quarterly update, and it said that yes, they've been producing lots towards the upper end of what it was previously expecting, but realized prices, or how much they're earning for each barrel that they're actually selling, has been not only dipping over the prior quarter, but also lower than what it made a year earlier. And they've also had a challenge of the leadership challenge. The CEO, Meg O'Neill, who's been in that CEO role for quite some time, has recently stepped down, and she'll be running oil giant BP from April this year.
We should also talk about uranium miners within that space. Of course, there is quite an upbeat outlook for uranium prices based on the demand for growing nuclear energy needs, but it's sort of varied within the uranium space, because Boss Energy actually fell back by 40% in 2025, and that's largely because it actually formally withdrew its feasibility study for its flagship project. So that really weighed on its share price towards the end of last year. But stocks like Paladin Energy were up 27% last year. Deep Yellow was up 65%. So we're really seeing a bounce back in these uranium miners as well.
We've got to discuss financial stocks, in particular the banks. That's because it's the largest area of our market. But as usual, the banks, as a group at least, don't release their results at the same time as everyone else, just to make things easy. But we do have CBA out with its half-year results on the 11th of Feb. That includes the announcement on the dividend, of course. And then the 16th of February, we've got Bendigo and Adelaide Bank out with a half-year result. We do get a bunch of quarterly results, though, that will be released over the course of the month. So that always gets attention. But as far as earnings go, we have to wait a bit longer, through to the opening week of May, to get the results from all the other banks, Macquarie, ANZ, NAB and Westpac included.
And I think since we are getting CBA's results this February, we should talk about its share price, because there were concerns about its share price being overvalued. I mean, it hit a record high in June 2025, but since then it's actually fallen back by around 21% from that record. So is it still overvalued? Of course, we know BHP overtook CBA, and in its recent trading update, CBA actually flagged increased competition and lower interest rates, which could hurt its margins. Of course, there is the prospect of a potential interest rate hike in February, so we should keep that in mind as well.
Yeah, consumer discretionary stocks is another group that we should really address, of course, one of the more sensitive areas to interest rate movements. So we haven't had a rate cut in Australia for 6 months now, but of course the headwind, as we've discussed in the past, is that there could be interest rate hikes in 2026, and that could certainly be a negative for this group.
Oh, it certainly can. So inflationary pressures is something that these retailers have been dealing with for quite some time now. You always see that C word in their results, challenging. You see consumers continuing to cut back on their spending. So I had a look at some of the recent trading updates from some of these companies. Keep in mind, some of these companies did actually hit record highs at the tail end of last year. We had Harvey Norman, JB Hi-Fi and Super Retail all at record highs. But what we were seeing out of their results was that they actually delivered record first half sales. That's for Super Retail Group. We did see Myer having its biggest Black Friday event on record. Premier Investments, which is of course the owner of Peter Alexander and Smiggle. They actually said that they delivered record sales across the Black Friday and Cyber Monday shopping period as well. Of course, that's a very critical time for these retailers, but I guess we'll be looking at, of course, with a potential rate hike on the cards, whether consumers are actually tightening their belt even more in this current landscape.
Absolutely. So ARB, I should mention as well, it certainly has been one of the big losers on the market recently, and that's because the four-wheel drive accessories retailer essentially said that it received, it basically warned of a 16% drop in profits for the half. It blamed this on movements in currencies, makes a lot of its products in Thailand, and currencies haven't gone in its favour there. So that's just made things more expensive for the group.
We should look at consumer staples as well. Of course, the two big names within this sector will be Coles and Woolies, and analysts are predicting that Coles will keep its competitive edge over Woolworths. We've seen Coles doing much better than Woolworths in their recent results, and it's been taking more of its market share as well. So this is something to keep in mind going into this reporting season.
Two other stocks we should mention in consumer staples. Treasury Wine Estates, which had an absolute shocker. It's down 33% or so over the past 6 months. So the worst performer in that consumer staple space. And that's partly because its performance in the US has been quite disappointing. Demand for wine has been a bit soft. It's looking at cutting back inventory in a couple of major markets. And A2 Milk, it's done okay over the past 6 months, but what a shocker it's had in Jan. 13% lower in 5 days. And one of the reasons for this, fewer babies being born in China in particular, and it's not really a term that's commonly used, but more babies, more dollars perhaps, because this is a company that needs babies to be born. It makes about 65% of its revenues just from infant formula, even though a lot of people maybe know A2 Milk for more of the fresh milk that it sells. Let's
look at the healthcare sector, because we know this sector has been quite sluggish. I mean, last year this sector was plagued by Trump's threats of 200% tariffs on the pharmaceutical industry. CSL, which is a major player within the Aussie healthcare sector, it had a brutal year last year. It was down something like 40%. Now, its core business is strong, but it's still struggling with soft US vaccine demand. It's also delayed its vaccine business spin-off due to bigger than expected declines in its US flu vaccine rates as well.
Yeah, I'll mention pathology companies, or all the rave, of course, during COVID. They were making millions of dollars from PCR or those COVID tests, of course. Since then, things have dried
up. Feels like
that's
a lifetime ago.
That's an income source that has completely disappeared. And also, there's been some Medicare funding cuts, which kicked in July last year. So stocks like Sonic Healthcare, Helios, they really struggled. But that means that, an unloved area, which if they beat expectations, there could potentially be a bit of a push higher for some of them.
And finally, we should also look at our tech sector. Of course, here in Australia, it's much smaller than over in the US. It accounts for roughly 2% of the Aussie market, while it accounts for about a third of the US market. So not quite as dominant as what they have over there, because we don't have as many big players. But of course, still something to watch in the coming reporting season. WiseTech is a company that perhaps we should be watching, because it's one of the biggest within that sector. Its shares did take quite a beating last year. They were down something like 44%. And stocks in the data center space are something else that we could potentially be watching. Of course, the big name within that sector is NextDC. And of course, we have seen a surge in demand for data centers. They recorded record contract wins due to that strong demand. They've also partnered with ChatGPT owner OpenAI in building what they've called a hyperscale AI data center campus in Sydney. So that's something that we should potentially watch out for in their results.
Yeah, and briefly, there are a couple of other stocks in there that received a lot of attention. Life360, the location tracking app, which rose 27% in one day, when it basically said it had a record increase in the number of users of its platform, but also more people are paying for the platform, which is always difficult for these type of companies. And also DroneShield is another which has been on a tear in January at least, but it's one of those companies that has double-digit percentage gains on a monthly basis for years now. That continues. Both Life360 and DroneShield only come out with their quarterlies recently, so it's not going to get as much attention in February though.
And of course, we will be covering reporting season throughout the course of February. You can listen in to our twice daily podcast, the CommSec Market Update, or keep up to date on our socials and also the CommSec website.